Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Hey everyone, and welcome back to another deep dive.
Yeah, welcome back.
Today we're tackling a topic that's close to the heart of any savvy real estate investor: rental yields.
Well, it's the bread and butter, right?
Absolutely.
Yeah.
We're dissecting an article aptly titled "Rocket Science Behind Rental Yield Calculations." And trust me,
It can seem that way sometimes.
it really can be. There are so many different formulas and metrics to consider, but don't worry, we're going to break it all down into bite-sized pieces.
Absolutely. We'll make it easy to understand and, more importantly, easy to apply to your own investment decisions.
Exactly. So let's start with the basics. When we talk about rental yield, we're essentially talking about the return you're getting on your investment.
Right. It's a way to measure how much income your property is generating compared to how much it cost you.
And this is where it gets interesting because there's more than one type of rental yield. We've got the gross yield, which is a pretty simple calculation. You just take your annual rental income and divide it by the property's purchase price.
But that's just the tip of the iceberg. The gross yield doesn't tell the whole story. Yeah, it's like judging a book by its cover, right?
Exactly.
Yeah.
Because it doesn't factor in all those essential expenses that come with owning and managing a rental property.
Things like mortgage payments, property taxes, insurance maintenance costs, those can really eat into your profit.
Absolutely. So to get a truly accurate picture of your return, we need to dive deeper into the net rental yield.
All right, so net yield is where the real magic happens. This is where we see the true profitability of a property because it takes into account all those pesky expenses.
It's all about getting down to the nitty-gritty, the actual cash flow you're putting in your pocket.
Exactly. And to illustrate this, the article gives a really helpful example.
Oh yeah, I love examples. They make it so much easier to grasp.
Like they really do. So let's say you've got your eye on a property that rents for $700 a month and the asking price is $120,000.
Okay, it sounds promising so far.
Right, at first glance you might think, oh wow, that's almost a 7% gross yield. Not bad.
Yeah, that's what a lot of first-time investors would think.
But hold on there, because once you factor in all those expenses, things start to look a little different.
Exactly. The mortgage payments, property taxes, insurance maintenance, maybe even some vacancy costs. All of a sudden, that shiny 7% yield starts to shrink.
Yeah, the article estimates that after subtracting realistic expenses, the net yield for this property could be closer to 3%.
That's a significant difference and a wake-up call for anyone relying solely on the gross yield.
It really shows how important it is to look beyond the surface and do your due diligence when evaluating potential investments.
Couldn't agree more. You don't want to be caught off guard by those hidden costs.
This reminds me of a friend who jumped at a property with a seemingly high yield, only to discover that after factoring in all the HOA fees and special assessments, it was barely breaking even.
Ouch. Yeah, that's a tough lesson to learn.
A costly one for sure. So we've established that net yield is the real MVP when it comes to assessing rental property profitability.
It's the gold standard for making informed investment decisions.
But the article hints at an even more powerful metric, something called the capitalization rate, or cap rate for short.
Now we're getting into the advanced stuff. Cap rate is like an X-ray vision for investors.
Ooh, I like that X-ray vision. Tell me more.
It allows you to see beyond the individual financing arrangements and assess the raw earning potential of a property.
So it strips away all the noise and gives you a clear picture of how well a property can generate income on its own.
Exactly. It levels the playing field so you can compare apples to apples, even if one property is financed with a 30-year mortgage and another is an all-cash deal.
So it's about isolating the property's intrinsic value, its ability to generate income regardless of who owns it or how it's financed.
Precisely. And that's why cap rate is such a valuable tool for experienced investors.
It helps you see beyond the surface and make data-driven decisions.
Exactly. So how do we calculate this magical cap rate?
It's actually pretty straightforward. You take the property's net operating income, which is the annual rental income, minus operating expenses.
Okay, so we're excluding any debt service here, just focusing on the income and expenses directly related to the property itself.
Exactly. Then you divide that net operating income by the property's purchase price.
It's simple yet powerful.
The article uses the same example we talked about earlier, that $120,000 property with $700 monthly rent.
Right, so assuming the annual rental income is A of 400, 700 by 12, and let's say the operating expenses are around $2,000 per year.
That gives us a net operating income of $6,400.
And when we divide that by the $120,000 purchase price, we get a cap rate of 5.33%.
So that 5.33% cap rate tells us the property has the potential to generate a 5.33% return on its value each year.
Regardless of how it's financed, whether it's a cash deal, a mortgage with a low interest rate or a high interest rate, the cap rate remains the same.
That's pretty insightful. It really helps you see beyond the financing and focus on the property's inherent earning power.
And that's what separates the pros from the amateurs.
Okay, so we've tackled net yield, we've demystified the cap rate, but let's be honest, at the end of the day, most investors are laser focused on one thing and one thing only: return on investment. That sweet, sweet ROI.
Ah, yes. ROI, the holy grail of investing.
It's the bottom line, right? How much money are you actually making on the money you've invested?
Exactly. And in the world of real estate, ROI is where things get really interesting because we have this powerful tool at our disposal: leverage.
Leverage the magic of mortgages.
Exactly. Using a mortgage to finance your property allows you to amplify your returns potentially significantly.
Okay, so let's bring back our trusty $120,000 property example. Remember, we calculated a net yield of around 3%.
Right, but that was assuming we paid for the property in cash.
Now let's say we secure a 75% mortgage, which means we only need to put down 25% or $30,000 as a down payment.
Okay, so we're leveraging our investment using borrowed money to control a larger asset.
Exactly, and this is where the magic happens. With that 75% mortgage in place, that 3% net yield suddenly transforms into an impressive 11% ROI.
Wow, that's a huge difference.
It highlights the power of leverage to supercharge your returns.
But of course, leverage is a double-edged sword. It can amplify gains, but also losses.
Absolutely. So it's crucial to use leverage wisely and always be aware of the risks involved.
Couldn't agree more. It's all about striking the right balance.
So we've got this fantastic 11% ROI, but it's also important to consider the payback period. How long will it take to recoup our initial investment?
Yeah, payback period is a good way to gauge the timeline of your investment.
In this case, with that 11% ROI, the payback period would be about 10 years.
Okay, so in about a decade, we'll have earned back the $30,000 we initially invested.
Exactly. And from that point forward, any rental income is pure profit.
Right, that's the
Yeah,
dream,
right.
right? Passive income for years to come.
Absolutely. Okay, so we've decoded net yield, we've mastered cap rate, and we've uncovered the power of leverage and ROI. But wait, there's more.
There's always more when it comes to real estate investing.
What about that wild card that everyone loves to talk about? Capital growth?
Ah, yes, capital growth, the
Mhm.
potential for your property to increase in value over time.
It's the icing on the cake, right?
It can be, but it's important to remember that capital growth is inherently unpredictable.
It's not something you can bank on with certainty.
Exactly. It's influenced by a myriad of factors: market trends, interest rates, economic conditions, even local zoning changes.
So while we can hope for those skyrocketing property values, it's crucial to focus on the metrics we can control. Rental yield, ROI, cash flow.
Those are your solid foundation, your reliable income stream.
This is making me realize that evaluating a property is like solving a multifaceted puzzle. There are so many pieces to consider.
Absolutely. It's not just about looking at the listing price and dreaming of future riches.
It's about understanding these different metrics and how they interact to paint a complete picture of the investment.
And that's what separates the successful investors from the rest.
Speaking of success, let's tackle a question that's on every investor's mind. What exactly is a good rental yield?
Ah, the million-dollar question. Is there a magic number?
I wish it were that simple, right?
Unfortunately, there's no one-size-fits-all answer. A good rental yield depends on a variety of factors.
Location, property, type, your personal risk tolerance, your investment goals.
It's all relative. But as a general rule of thumb, a rental yield of 12% or higher is considered pretty solid.
Okay, so that's a good benchmark to aim for.
It is, but remember, it's just the starting point.
So we should always adjust our expectations based on the specifics of each property and our own investment strategy.
Exactly. For instance, you might be willing to accept a lower yield in a high-growth area where you anticipate significant capital appreciation.
Whereas if you're looking for steady cash flow, a higher yield in a stable, established market might be more appealing.
It's all about aligning your investment choices with your overall financial goals.
This is highlighting how important it is to know yourself as an investor.
Mm.
What are your priorities? What level of risk are you comfortable with?
Self-awareness is crucial in real estate investing.
And to gain a deeper understanding of the short-term financial health of an investment, we can turn to cash flow analysis.
Cash flow is king, right?
Absolutely. It's all about making sure the property is generating enough cash to cover all the expenses and debt service.
You don't want to find yourself in a situation where you're constantly dipping into your own pocket to keep the investment afloat.
Exactly. And one handy tool for assessing cash flow is the payback ratio.
The payback ratio tells you how long it will take for the property's net cash flow to recoup your initial investment.
So essentially, it's a measure of how quickly you can expect to break even.
A shorter payback period is generally more desirable, as it means you're recouping your capital faster and reducing your risk.
It's valuable information when comparing different investment options.
Absolutely. So we've got our long-term metrics like net yield and cap rate, and our short-term cash flow considerations.
But the question is, how do we actually use all this knowledge in the real world?
That's where the rubber meets the road, right?
Exactly. Can we use these calculations to determine what we should pay for a property?
Absolutely. You can reverse engineer the formulas to determine the maximum price you'd be willing to pay based on your desired return.
So let's say you're aiming for an 8% ROI.
You can plug that target ROI into the formula along with the property's projected income and expenses.
And then adjust the purchase price until you hit that sweet spot.
This gives you a powerful negotiating tool, ensuring you don't overpay and jeopardize your target return.
This is mind-blowing. It's like having a secret decoder ring for real estate.
It empowers you to make data-driven decisions and negotiate with confidence.
It's about taking control of your investments and not just relying on gut feeling or speculation.
Exactly. It's about being an informed and strategic investor.
This has been an incredible deep dive so far.
We've barely scratched the surface.
We've cracked the code of rental yield, cap rate, ROI, and even dipped our toes into cash flow analysis.
But hold on tight, because there's so much more to explore.
In part 2, we'll unveil even more advanced concepts and strategies that will take your real estate game to the next level.
Get ready for the next chapter of our rental yield rocket science adventure.
Stay tuned because the journey continues.
Welcome back to our rental yield roller coaster.
Round 2. I'm ready to dive back in.
Today, we're going even deeper, uncovering some seriously powerful tools for real estate investors.
All right, lay it on me.
We're going to be talking about something called initial rental yield.
Initial rental yield, what's that all about?
Well, it's a way to estimate a property's potential value based on its future income.
Wait, so like a prediction of how much it could be worth down the road?
It's like having a sneak peek into the future of your investment.
Okay, I'm intrigued, but honestly, predicting future value sounds a bit like guesswork.
I hear you. It's not about pulling out a crystal ball, but it does involve a bit of financial forecasting.
So how does it actually work?
It all boils down to this. A property's value is directly tied to how much income it can generate.
Okay, that makes sense.
So if we can estimate the future rental income and then factor in something called a discount rate, we can get a pretty good idea of what the property might be worth.
All right, break it down for me. What's this discount rate all about?
Well, imagine this. Would you rather have $100 today or $100 a year from now?
A tough choice, but probably $100 today.
Exactly. Money today is worth more than money in the future.
Yeah.
You could invest that $100 today and potentially earn even more.
Yeah, plus there's always the risk that something could happen and I might not even get that $100 a year from now.
Precisely. That's the idea behind the discount rate. It reflects the time value of money and also accounts for the risk involved in any investment.
Got it. So how do we use this initial rental yield calculation to figure out a property's potential value?
All right, let's say we're looking at a property and we estimate that it'll bring in about $5,000 a year in not rental income.
Okay, $5,000 per year.
Now we need to choose a discount rate. Let's say for this example, we go with a reasonable 8%.
All right, 8% it is?
Then we simply divide the net income, which is $5,000, by the discount rate, which is 8%, or 0.08.
Okay, so 5,000 divided by 0.08, that gives us $62,500.
Exactly. So according to our initial rental yield calculation, this property has an estimated potential value of around $62,500.
That's pretty cool. It's like we've gotten a glimpse into the future of this property.
Of course, it's important to remember that this is just an estimate.
Yeah, things could change, right? Rental rates might go up or down, unexpected expenses could pop up.
Absolutely. The accuracy of this calculation depends on how realistic our income projections are and the discount rate we choose.
So it's all about doing your research and making informed assumptions.
Precisely. The more accurate your data and the more realistic your projections, the more reliable your initial rental yield calculation will be.
Okay, this is giving me a whole new perspective on evaluating properties, but something tells me we're not done yet.
You're right. We've got another powerful metric up our sleeve. Cash-on-cash return.
Cash-on-cash return. Another new term.
It's a favorite among investors who use leverage to maximize their returns.
Ah, leverage the magic of mortgages.
Exactly. Cash-on-cash return specifically measures the return you're getting on the cash you've actually invested in the property.
Okay, so it takes into account the fact that we're not always paying for the entire property up front.
Precisely, it factors in the mortgage and tells you how effectively your down payment and other out-of-pocket expenses are working for you.
So it's like a laser-focused view of the return on our own money.
Exactly. And it's especially useful when comparing different investment scenarios.
Okay, I'm following you so far, but can we see it in action? Let's use our trusty $120,000 property example again.
Perfect. Remember, we put down $30,000 for the down payment and calculated an 11% ROI.
Right, because of the leverage from our mortgage.
Exactly. But what's the cash-on-cash return in this scenario?
I'm not sure how would we calculate that.
Well, let's say after covering all expenses and debt service, the property generates $3,000 in annual pre-tax cash flow.
Okay, $3,000 in cash flow.
Then we simply divide that $3,000 by the $30,000 we invested as a down payment.
So 3,000 divided by 30,000, that gives us a cash-on-cash return of 10%.
Precisely. Not bad, right? Especially considering it's solely based on the cash we actually put into the deal.
Yeah, that's pretty impressive. It really shows how leverage can amplify your returns.
But remember, it's important to use leverage responsibly and always assess the risks involved.
Absolutely. So now we have ROI, which gives us the overall picture of our return.
And cash-on-cash return, which hones in on the performance of our own invested capital.
Both valuable metrics, but each offering a slightly different perspective.
Exactly. It's like having two different lenses to analyze your investment from.
This is making me rethink how I evaluate potential deals. It's not just about chasing the highest ROI anymore.
It's about understanding the nuances of leveraged cash flow and making informed decisions that align with your overall investment strategy.
Speaking of strategy, let's talk about another interesting concept: discount yield.
Discount yield. This one's all about finding those hidden gems in the market.
Hidden gems sounds exciting. Tell me more.
Discount yield is all about identifying properties that are selling for less than their appraised value.
Okay, so like getting a bargain on a property.
Exactly. It's like finding a winning lottery ticket for real estate investors.
All right, I'm all about finding those deals. How do we calculate this discount yield?
It's a pretty simple formula. You subtract the purchase price from the appraised value and then divide that difference by the appraised value.
Okay, so let's say we find a property that's appraised at $150,000, but the seller is motivated, and we're able to negotiate a purchase price of $140,000.
Right, so that's a $10,000 difference between the appraised value and the purchase price.
We divide that difference by the appraised value, which is $150,000.
And that gives us a discount yield of about 6.6%.
Wow, so we're essentially getting a 6.6% return on our investment right from the start.
Precisely. Just by being savvy negotiators and finding a property that's undervalued.
This is making me realize that there's so much more to real estate investing than meets the eye.
It's not just about numbers. It's about market knowledge, negotiation skills, and recognizing opportunities when you see them.
And having the right tools and strategies to capitalize on those opportunities.
Exactly. We've covered a lot of ground here, from net yield and cap rate to cash-on-cash return and discount yield.
My rental yield toolbox is overflowing.
But before we move on to the grand finale, there's one last metric we need to revisit. The payback ratio.
Yes. The payback ratio, we touched upon it briefly in part 1.
It's such an important concept that it deserves a little more attention.
So remind me again, what exactly does the payback ratio tell us, and why is it so crucial?
It's all about timing. The payback ratio tells you how long it will take for a property's net cash flow to pay back your initial investment.
So basically, how long until we break even and start seeing positive cash flow?
Exactly. It's a valuable metric for assessing the attractiveness of an investment, especially if you're looking for quicker returns.
A shorter payback period generally means you're recouping your capital faster and reducing your risk.
Absolutely. And it's a key factor to consider when comparing different investment options.
This is really driving home the point that real estate investing is a multifaceted game.
It's not just about chasing the highest returns. It's about finding investments that align with your individual goals, your risk tolerance, and your desired timeline.
This deep dive has been an incredible journey so far.
We've gone from rental yield newbies to seasoned analysts armed with a toolbox of powerful metrics and strategies.
But we're not done yet. In the final part of this deep dive, we'll tie everything together and explore how to use all these calculations to make smarter, more profitable investment decisions.
Get ready for the grand finale of our rental yield rocket science adventure.
All right, welcome back to the final act of our rental yield deep dive. We've cracked the code, we've learned the lingo, we've got a toolbox full of powerful metrics.
Now it's time to put it all into practice.
Exactly. We've been talking a lot about theory, but how do we actually use these calculations to make smarter, more profitable investment decisions?
That's the million-dollar question. And the beauty is that these calculations are more than just abstract concepts.
Yeah, they're practical tools, right?
Precisely. They're the keys to unlocking a world of real estate opportunities.
So let's get tactical. What are some specific ways we can use these calculations to our advantage when evaluating deals?
Well, one powerful approach is to set clear investment criteria based on your desired returns.
Okay, so like having a benchmark in mind.
Exactly. For instance, let's say you've decided that an 8% cash-on-cash return is your minimum acceptable threshold for an investment.
So any property that doesn't meet that 8% target is immediately off the table.
It's like having a filter, screening out the properties that don't align with your financial goals.
I love that. It's about being laser focused and not wasting time on deals that won't deliver the returns you're looking for.
Exactly. It helps you streamline your search and concentrate your efforts on the most promising opportunities.
Okay, that's brilliant. What other strategies can we deploy using these calculations?
Another valuable tactic is leveraging these metrics during negotiations.
Ah, negotiations. The heart of any real estate deal.
Precisely. Imagine you found a property that ticks all the boxes, but the asking price is a bit steep.
This happens all the time, right?
Right.
How do we use our newfound rental yield knowledge to navigate those negotiations effectively?
Instead of just throwing out random numbers or getting caught up in an emotional bidding war, you can use your understanding of ROI, cash-on-cash return, and other metrics to craft a data-driven counteroffer.
So it's about backing up our offer with solid financial analysis.
Exactly. You're showing the seller that you're not just guessing, you're a serious buyer who understands the numbers and the value proposition.
That makes so much sense. It takes the emotion out of the equation and puts the focus on concrete data.
And that can give you a significant advantage at the negotiating table.
This is really empowering. I feel like I'm no longer at the mercy of the market or a smooth-talking seller. I have the tools to analyze the numbers and make informed decisions.
That's the power of knowledge, and that's what we've been striving for in this deep dive.
This has been an incredible transformation. We started feeling a bit overwhelmed by all the formulas and metrics.
But now we're wielding them like pros.
Exactly. We've gone from rental yield rookies to seasoned analysts ready to take on any real estate challenge.
And remember, the learning never stops. The more you apply these concepts, the sharper your skills become.
It's like we've unlocked a secret code to the real estate market.
The language of profitable investing.
And as we continue to explore and learn, the more fluent we become in that language.
Exactly. The journey never truly ends, but that's what makes it so exciting.
This deep dive has been an absolute game changer. I feel like I have a whole new level of understanding and confidence when it comes to rental yield and real estate investing in general.
And that's what it's all about, arming yourself with the knowledge and the tools to make smarter, more informed decisions.
So to all our listeners out there, don't let the rocket science of rental yield intimidate you.
Embrace the challenge.
Master the formulas.
And unlock a world of real estate possibilities.
That wraps up another insightful episode of The Deep Dive. We hope you've enjoyed exploring the world of rental yield calculations with us.
Until next time.
Happy investing.